Hello students, welcome to my class. This is Professor Vincent Osaya and this is part 2 of the presentation of chapter 7, Internal Control and Cash. In part 1, we talked about the overview of the whole chapter and we completed objectives 1 and 2. In this part, we are going to start with the objective number 3, that is how to apply internal control to cash payment. So what we are talking about here is the plan, the procedures that you put in place to protect your cash during the process of disbursing it or paying it out. Let me give you an example. It is not unusual at all especially for small businesses, whereby one person is responsible for paying the bills, writing the checks, depositing the money, doing the bank reconciliation, the whole 9 years. So the authorization, the custodian, and the record keeping functions of cash payment usually lies on one person for a very small or medium-sized company. But for a lot of primarily small companies, but for a lot of medium-sized and large companies, they have enough resources to hire several people so that all these duties are properly segregated or separated. Now, here is what I advise my clients, my small business owners client. And I say to them, okay, you have one person doing all these functions. The least thing you can do is you need to have your bank statement mailed to your house. When you get your bank statement, open the bank statement and review all the transactions before you give the bank statement and the cancelled checks to the office manager that is responsible for all these functions. So by so doing, the office manager realizes that if he or she writes a check that is not supposed to be written, or if that person engaged in any fraudulent activity, of course the owner of the company is going to be aware of it. Now, so moving forward, let's take a look at some of the applications of internal control to cash. Take a look at this diagram. It's very typical. This company, Smart Touch Learning, actually prepare purchase order authorizing the electronics manufacturer to send him some goods. So the electronics manufacturer will ship the goods, in this case merchandise inventory, and send the invoice along to Smart Touch Learning, that is the company, the buyer. Then the company receive the invoice, the inventory along with the receiving report, and the company eventually will send the check to the electronics manufacturer. We also said that it is extremely important that the transactions of a company, almost every transaction of a company should be carried out using checks instead of cash. Why is that important? Because it provides an audit trail, and you have a paper trail relative to these your cash disbursement. So we said that it is a very good internal control to ensure that almost every transaction is paid with check. Now, having said that, that is the overview of objective 4. So we are not going to get into objective 3 now. Objective 4. Why it is a good internal control measure to issue check for every transaction or almost every transaction? Realistically, it is not feasible because we have a lot of petty, very small, inconsequential transactions that we can only issue a check for. So in some circumstances, it becomes very important for the company to have a small amount of cash with the secretary or the receptionist for petty expenses. So objective 4, so we are going to talk about how to journalize petty cash transactions. In other words, we need to talk about the accounting issues relative to petty cash. So again, petty cash is used as an in-office source of cash for immediate petty expenses. One individual in the company is designated to be responsible for the petty cash function. Now, It is a general rule in petty cash accounting that no cash should be removed unless a receipt is provided. So here are some of the examples of petty expenses, petty expenses that the company would carry out during the course of a day. For example, office donor, public transportation, so on and so forth. It is not just efficient for us to issue checks for some of these transactions, or not even feasible for that matter. So now, what is the accounting treatment, or how do we account for petty cash, or how do we record petty cash? So the first transaction here is how to set up petty cash. So what we are doing here is, normally we will write a check to XYZ or to the receptionist, let's say for $200. When we do that, we will debit petty cash account. Petty cash account is an account, and we'll credit cash. So on one hand, cash is going down. On the other hand, we also have another type of asset called petty cash that is being increased. So we said this is the journal entry for setting up a petty cash fund, or we also say to establish a petty cash fund. So so after the check is cashed, the cash is physically placed in the petty cash fund, and one individual is responsible for it. So if you need $5 for transportation, the petty cash individual or the receptionist that is responsible for the petty cash will give you $5, and you bring a $5 receipt, or vice versa. Now, at the end of the month, it becomes important for us to record the petty cash transactions. So let's take a look at what happens. If we have $200 and $180 has been spent, or $190 has been spent, ordinarily you will have $10 cash and $190 worth of receipt. Out of the $200, if $40 has been spent, then of course the individual should have $160 cash and $40 in cash receipt. So at the end of the month, our desire is for the receptionist to have exactly the same amount at the end of the month, or at the beginning of the following month. So we call that replenishing petty cash. So let's take a look at the example that we have here. We started with $200, all right? Now the cash on hand was $118. Now if cash on hand was $118, then we should have a petty cash receipt of up to the tune of $82. But in this case, we have only petty cash ticket or receipt of $80. So 118 plus 80, that gives you 192. So obviously $2 is missing, and that probably might be due to the fact that the petty cash, the receptionist who is responsible for petty cash did not give out a proper receipt, or somebody stole $2, whatever the case might be. But nevertheless, our desire is for the receptionist to have $200 at the beginning of the following month. So let's take a look at the journal entry that we will record to replenish the petty cash. So when we tally the receipt, we find out that we spent $60 in office supplies. So we debit office supplies for $60. We spent $20 for delivery expense. So we debit delivery expense for $20. Now we credit cash for $82 because our desire is for the receptionist to have $200. Recall in the last slide we said that the cash on hand was $118. So for him to come up with $200 at the beginning of the following month, then we need to give it. We need to issue $82 check to the receptionist. Now to balance out the equation, then we need to debit an account called cash short and over by $2. Now if we are over, then cash short and over accounts need to be credited instead of debited. So this is the journal entry to replenish petty cash. There's something very important that I want to draw to your attention, which you should watch out on the examination. That is, when you replenish petty cash fund, petty cash fund account is not applicable. So let's go back to the first journal entry. The first journal entry where we establish petty cash, we debit petty cash for 200 and we credit cash for 200. When we replenish petty cash, take a look at what happened. We debit all the related or the related or relevant expense accounts and we credit cash without petty cash fund being involved at this time. The only time we bring petty cash account into existence is when we establish it, or when we increase the level of petty cash, or when we decrease the level of petty cash. So those issues are not being discussed here. So that is the accounting treatment for petty cash. So moving along, let's take a look at the objective 5. Here we are going to demonstrate the use of a bank account as a control device and prepare a bank reconciliation and the related journal entries. Now, we said that it makes sense and it makes for good internal control for every company to have a bank account so that they can keep their cash in the bank. Now, what are the advantages of keeping your cash in the bank instead of keeping your cash in the premises? Two obvious advantages. Number one, the bank is a specialist for safeguarding your cash. Number two, it's a security issue. Can you just imagine if the bad boys know that a particular company keeps all their cash, hundreds and thousands of dollars in their premises? That company will be asking for some serious problems. So we said that it is a good internal control for every company to have a bank account as a security measure. Now there's another reason why, another advantage of having a bank account. What happens is the company keeps track of the cash and the bank also keeps track or keeps record of your cash as well. So you wind up with two parties keeping record of the same thing. The company keeps track or records of cash and the bank also do likewise. So we have two records for the same thing, and of course, as you know, we indicated that cash is the most vulnerable and the most valuable asset of a company. So that is the overview of the bank account as a control device and a bank reconciliation. So in the next part 3 of this presentation, we are going to get into details as to how to perform bank reconciliation and other related issues relative to bank accounts.